Wow, you've really piled it on this time. Ethereum, huh? Seems like we're going deep down the rabbit hole with this one. Articles, analyses, your own thoughts. It's a lot to unpack.
Yeah, it's quite the collection. Articles talking about ETH as an investment, others digging into the tech behind it, some even comparing it to, like, traditional assets.
So where do we even begin? I guess our mission, like always, is to cut through the noise, find the signal in all this data. What exactly is Ethereum, the network, and ETH, the asset?
Hmm.
What makes it unique? Is it something institutions should even care about? And what about its role in the whole digital asset world?
Right, right. Well, one thing that jumps out is that there's a lot of buzz, a lot of momentum behind Ethereum. It's kind of like, Bitcoin went through a similar phase, becoming this digital gold, a store of value.
Right.
But ETH, it's doing that, but it's also got this whole yield generating thing going on.
Oh yeah, the staking. You can actually earn a return on your ETH just by holding it, which is pretty different from Bitcoin.
Huge difference. And the sources we've looked at, they're suggesting that ETH is becoming a kind of a reference indicator for the entire digital asset space.
A reference indicator, what does that even mean?
Think of it like this. How ETH performs, how active its network is, it's starting to impact financial markets, both public and private. And, get this, it's even influencing the monetary policies of other digital networks. It's all kind of connected.
So it's like the pulse of the whole digital economy.
Yeah, something like that. And the numbers, they're not small potatoes either. Over $315 billion in market cap, millions of active users every month. This is real financial activity happening on Ethereum.
And that brings us to the comparisons with traditional finance. Some of these articles are drawing parallels between ETH and, wait for it, U.S. Treasury bills.
Oh, right. It sounds crazy, but it's actually pretty interesting. They both kind of set a benchmark, act as a safe haven when things are shaky, and influence expectations about, where the economy's headed.
And we've already touched on the two big things for ETH, generating yield through staking and its use as collateral. But why are those so important?
Because they elevate ETH beyond just being a digital currency. The yield means there's a built-in return mechanism. And its use as collateral, well, that shows growing acceptance. It's becoming a utility within the financial system, even if it's a digital one.
Okay, let's break down this whole yield thing. How does staking actually generate returns?
All right, well, the core of it is Ethereum's move to this proof-of-stake consensus mechanism. It was a big shift from the old proof of work, and it's way more energy efficient.
Yeah, I remember all those articles about Bitcoin mining farms guzzling energy. POS is different, right?
Totally. Instead of miners, we now have validators. Think of them as participants who create new blocks on the chain and verify transactions. And they get selected based on how much ETH they stake, basically lockup. More ETH staked, higher the chance to be chosen. Kind of like if you have more invested in your neighborhood, you're more likely to keep an eye on things.
Makes sense. And having something at stake encourages honesty.
Exactly. If a validator tries to cheat, tries to validate a bad transaction, they can get penalized. Their ETH gets slashed. So it's like their financial interests are aligned with the network's security. Now, the yield itself comes from three main places.
Lay it on me.
First, there's issuance. New ETH is constantly being created and added to the circulating supply. Right now, it's about 2.8% per year based on the total ETH staked.
So new ETH goes to validators as a reward for staking.
Right. It's distributed proportionally. Now, the minimum the network will issue is 1.5% per year, guaranteed. But here's the thing. As more and more ETH gets staked, that yield from issuance, it goes down. Same pie, more slices.
Okay, I'm with you. What's next?
Tips. This came with the London upgrade, specifically with EIP 159. Remember that. It changed the whole transaction fee game.
Vaguely. Refresh my memory.
Well, now there's this base fee that fluctuates depending on how busy the network is, but users can add a little extra, a tip, if they want their transaction to go through faster.
So if I'm in a hurry, I can slip the validator a little something extra.
Exactly. And those tips, they go straight to the validators.
Makes sense. All right, what's the third piece of the puzzle?
This one's a bit more complex. It's called miner extractable value, or MEV. Even though we don't technically have miners anymore, the name has kind of stuck. Basically, it's the profit validators can make by, well, let's just say they get to see the pending transactions, what's in the mempool, and they can strategically include, exclude, or even reorder them in the blocks they create.
Hold on. Reordering transactions. How does that work in practice?
Imagine someone's about to buy a ton of a specific token on a decentralized exchange. A validator, using some fancy MEV software, sees that order coming. They could, buy a bit of that token themselves just before that big order hits, maybe drive the price up a tiny bit, and then sell once the big order goes through, pocketing a little profit.
It's kind of like playing the market within each block.
You got it. It's often compared to payment for order flow in traditional markets, where brokers get paid to route orders to certain market makers.
Now, you mentioned a base fee earlier that doesn't go towards the staking yield. What's the deal with that?
Right, the base fee, that's the standard cost for any transaction on Ethereum. But the key thing is it gets burnt. It's permanently destroyed, removed from circulation.
So no one gets it.
Nope, it's gone. Poof. Which actually has some pretty big implications. It makes fees more predictable, and if more ETH gets burnt than created, well, the overall supply shrinks. Deflationary.
And the sources say that's actually happening.
Yep, it seems to be. Since we moved to proof of stake and EIP 1559, Ethereum's been, on average, deflationary. Supply is decreasing by something like 0.106% per year.
Wow, that's wild. What's driving that?
Two main things, I think. First, proof of stake is just way cheaper to run than proof of work. Validators don't have huge electricity bills like miners did, so less pressure to sell their ETH rewards to cover costs. Second, Ethereum is still the king of smart contracts. Tons of development happening, lots of value being transferred on the network. Even with, the transaction speed limitations we have now, it's still the main game in town.
Okay, so we've got a pretty good grasp of the yield stuff. Now, this MEV thing, these sources say it could potentially predict economic cycles. That's a pretty bold claim.
It is, but there's some logic to it. Remember how MEV is kind of like payment for order flow? Well, market makers, they're usually willing to pay more for orders from, let's say, less informed retail traders. So just like a spike in PFOF might signal lots of retail activity, maybe even, a bit of frothiness in the market, a surge in MEV on Ethereum could mean the same thing.
So more MEV, more retail traders piling in. And what about a drop in MEV?
Could mean things are cooling down. The sources even pointed to some examples like before the big crypto crash in 2022, there was a noticeable dip in MEV activity, kind of mirroring what happened with PFOF in traditional markets around that time. So yeah, it's definitely something to watch.
Fascinating. Now, they also mentioned that a lot of this MEV activity might move to layer 2 networks in the future.
Right, layer 2s. They're built on top of Ethereum to basically make it faster and cheaper to use. They handle a lot of the transactions, and that's only going to increase. And since they tend to attract more retail users who are, sensitive to fees, it makes sense that MEV would follow them.
But aren't there some limitations with MEV on the current layer 2s?
Yeah, some of the big ones like Arbitrum and Optimism, they use a single sequencer to order transactions. So there's less opportunity for that strategic reordering that drives a lot of the MEV on layer 1. But as these layer 2s get more decentralized, their MEV potential will likely explode.
So even now, MEV is becoming a valuable indicator, especially with how retail trading influences it. And it helps us think about the value of layer 1s like Ethereum.
Exactly. It's a brand new metric to keep an eye on in this crazy crypto world.
Okay, let's shift gears a bit. The sources also talked about whether ETH has bond-like characteristics. That's an interesting comparison.
It is. Bonds are like a fundamental part of traditional finance, right? Now, staked ETH isn't exactly a bond, not a government bond anyway, but there are some similarities worth exploring.
But the sources also emphasized that the differences, especially the risks, are just as important.
Definitely. Let's break it down. With credit risk, a bond, there's always a chance the issuer might default, right? Can't pay their debts. With staked ETH, well, the network can't really default, but the yield, that can change depending on how busy the network is, how many people are participating.
Okay, then there's inflation risk. With bonds, inflation eats away at your returns. For ETH, the risk is if they create way more new ETH than they burn through those base fees. Too much supply, yield gets diluted.
And then you've got interest rate risk. When interest rates change, bond prices go up or down. With ETH, it's not exactly the same, but the yields offered by other layer 1s, those can definitely influence how attractive ETH staking looks.
We also have to think about currency depreciation risk. If a country's currency weakens, their bond payments are worth less in other currencies. Similarly, ETH's value can fluctuate against, say, the US dollar or other cryptos. That affects how much your staking rewards are really worth.
Political and legal risk, that's a big one too. Governments can change the rules, affect bond markets. For staked ETH, the risks are more about network security, like your stake getting slashed if you do something shady. And of course, there's the whole regulatory uncertainty hanging over the crypto world.
And then there's just plain old volatility risk. Bonds, they're generally pretty stable in price. Staked ETH, well, it's still early days. It can be a roller coaster ride.
So while you can try to model a staked ETH bond, and some people do, there are some key differences. The yield isn't fixed, and you can always unstake your ETH whenever you want.
Right, it's not locked in like a bond. Though the sources did mention that we might see an ETH yield curve develop over time, which would make the bond analogy even stronger.
Yeah, as the market matures, that's definitely possible.
Okay, so staking generates yield. There are some bond-like aspects to it, but also some key differences. Now, what about this idea of staking, and specifically restaking, making ETH more useful as collateral?
This is where liquid staking derivatives come in, or LSDs. They're protocols like Lido with their Steth token that make staking easier and more accessible.
So instead of staking my ETH directly, I can just use Lido and get Steth, which represents my staked ETH and earns rewards.
Exactly. And Steth, it automatically adjusts to reflect your rewards, currently around 3.2% per year. Plus, it's a regular ERC20 token, so you can use it all over DeFi. Lending, borrowing, trading, you name it.
And the sources are saying that Steth is becoming a pretty popular form of collateral in DeFi.
Hugely popular. Tons of it is being used on platforms like Aave, Spark, MakerDAO. It's even a big part of liquidity pools on decentralized exchanges. The fact that it's already earning yield makes it really capital efficient as collateral.
Now let's talk about this restaking thing with Eigenlayer. That sounds like a whole other level of complexity.
It kind of is, but it's also really cool. Basically, if you've already staked ETH, maybe through an LSD like Steth, you can then restake or repledge it on Eigenlayer to help secure other protocols. And in return, you get even more yield on top of your regular staking rewards.
So I'm using my staked ETH to secure multiple networks at once and earning multiple streams of rewards.
You got it. It's like double dipping on yield. And Eigenlayer has grown like crazy. It's solving a real problem for new protocols that need help with security.
And for investors, this restaking thing gives them more control over their risk and potential return.
Exactly. Higher yield, but also a bit more risk because you're exposed to the security of those other protocols. And we're starting to see liquid restaking tokens emerge, kind of like Steth, which will make this whole thing even more accessible.
So the takeaway here is that all these different forms of yield-bearing ETH, they're becoming the collateral of choice in DeFi, both on Layer 1 and Layer 2.
Definitely a trend to watch. ETH's not just a store of value anymore. It's this versatile, programmable asset that can be used in all sorts of interesting ways.
Now, the sources also discuss whether ETH's staking yield is becoming a kind of benchmark for the whole crypto economy. That's a big statement.
It is, but hear me out. We already talked about staked ETH being somewhat like a sovereign bond and a high-quality asset in DeFi. Well, think about how that yield influences other investments in the crypto space.
It's like a baseline for expected returns, kind of like the risk-free rate you hear about in traditional finance.
Not exactly risk-free, remember, we're still talking about crypto here, but it's becoming this reference point. For example, other Layer 1 platforms, the newer ones, they often need to offer way higher staking rewards to attract validators. They're seen as riskier than Ethereum, so they have to, sweeten the deal.
Makes sense.
Yeah.
Why stake on a risky new chain if you can get the same or even better returns on Ethereum?
Exactly. And a lot of those high yields on other Layer 1s, they come from inflation, which can hurt people who aren't staking. It's not like ETH, where the base fee burning can actually make it deflationary.
What about stablecoins? Is the ETH staking yield affecting them?
Oh, definitely. Since ETH yield is becoming this benchmark, it makes holding stablecoins less appealing. Why just sit on stablecoins when you could be earning a decent return on ETH? So protocols like MakerDAO have had to raise their interest rates to compete. And lending platforms, they're seeing higher borrowing rates for stablecoins because people want to borrow them against their ETH.
And this benchmark effect, it even extends to yield farming opportunities in DeFi.
Totally. New protocols that want to attract ETH capital, they need to offer really juicy incentives. They can't just offer the same yield as staking ETH. They got to beat it, which makes it more expensive for them to grow.
So for investors, it's like, why bother with this risky new project when I can just stake ETH and get a solid, relatively safe return?
Exactly. The sources even give an example. Imagine a closed-end fund with a 7-year lockup. They'd have to outperform a 4% ETH yield by over 31% just to break even. And that's just to break even, not even counting the risk.
Wow, so ETH's yield is really shaping the whole investment landscape in crypto. Now, the final big question from these sources is about ETH's hybrid nature. It doesn't seem to fit neatly into traditional asset categories, does it?
Not really. Bitcoin, with its fixed supply, it's often called digital gold, right? A pure store of value. Ethereum's more complicated.
The sources mentioned Robert Greer's classic asset classes. Capital assets, consumable assets, store of value. Where does ETH fit in?
Well, we talked about the staking yield. That gives it some characteristics of a capital asset, something that generates cash flow. But you also need ETH to pay for transactions on the network, the gas fees, so it's also a consumable asset. And while it does have store value properties within the smart contract ecosystem, most people agree that, Bitcoin still holds that crown.
So it's not a perfect fit for any one category. What is it then?
The sources call it a new kind of hybrid asset. It's got some store value aspects, sure, but its programmability, its ability to generate cash flow, and its use as collateral, those are all unique. It's blurring the lines between traditional categories.
And the fact that ETH and STETH are so liquid, so easy to trade, that also adds to its appeal.
Absolutely. And with spot ETH ETFs potentially on the horizon, we could see even more mainstream adoption, less volatility, making it an even more attractive way to get exposure to the smart contract world.
Okay, finally, I want to touch on those articles from Benzinga and My Money Plan about the intrinsic value of Ethereum. They go beyond just the market price and look at the fundamental reasons why ETH has value.
Yeah, those were some good reads. One key argument they make is that, unlike Bitcoin, which some people say is just speculation, Ethereum has real practical uses.
They highlighted the smart contract capability as the main driver of that intrinsic value, right?
Right. Ethereum was built for smart contracts and dApps, decentralized applications. And we're seeing real-world use cases pop up everywhere. DeFi, NFTs, the whole shebang. Plus, there are way more dApps on Ethereum than on any other blockchain, which shows you how dominant it is.
And DeFi, that seems to be a huge part of Ethereum's value proposition.
Absolutely. Ethereum is like the backbone of DeFi. All those lending, borrowing, trading platforms, they're mostly built on Ethereum. The amount of money locked in DeFi and Ethereum is just mind-boggling. It shows you how much real economic activity is happening there.
And they also talked about Ethereum being this new form of connectivity, a new kind of infrastructure, right?
Yeah, it has the potential to completely change how we think about finance and technology. Think about it. Mortgages, stock trading, all kinds of things could be done on Ethereum on a global scale without needing traditional intermediaries. It's still early, but the possibilities are huge.
The move to proof of stake, that was also mentioned as a big plus for Ethereum's value.
Right. POS makes it more energy efficient, but it also sets the stage for major improvements in transaction speed, which is essential if Ethereum wants to be this global financial platform.
And even before the full Ethereum 2.0 upgrade, Ethereum was already faster than Bitcoin, right?
Oh yeah, much faster. And they're working on making it even faster. They want to reach transaction speeds that rival traditional payment systems.
The disinflationary supply mechanism, that also seems to be a big deal.
It is. Unlike Bitcoin, which has a fixed supply, Ethereum's issuance rate is controlled. And with the base fee burning, it can even be deflationary. Less supply, more demand. You know how it goes.
And the correlation with Bitcoin, it's been decreasing, right?
Yeah, they used to move in tandem, but now ETH is increasingly being driven by its own fundamentals, its own use cases. That's a sign of maturity, becoming its own thing, not just riding Bitcoin's coattails.
And at the most basic level, ETH is what you need to use the Ethereum network to pay those gas fees.
Right. Exactly. Want to interact with a smart contract? Need ETH. Want to send tokens? Need ETH. As the network gets more popular, that demand for ETH will only go up.
That article on My Money Plan used a clever analogy comparing the EVM to a raffle business. It really highlighted how smart contracts can automate trust and make things more efficient.
Yeah, I like that one too. And they also talked about crowdfunding. Smart contracts can make that whole process more transparent, less risky for everyone involved.
And NFTs, they're a big part of the Ethereum ecosystem as well, adding to its value.
Huge. NFTs solve the problem of digital ownership. They let you prove that you own something digital, which is important in this, increasingly digital world. Remember when Eminem bought that Bored Ape NFT? It was all over the news. That's the power of NFTs on Ethereum.
So to wrap it all up, Ethereum's intrinsic value comes from its utility, its real-world uses. It's powering the EVM, all those dApps, and its supply is controlled, potentially even deflationary. As more people use Ethereum, its value should theoretically increase.
Makes sense to me.
So what do we learn today? Well, Ethereum is more than just another cryptocurrency. It's this evolving, yield-bearing, programmable asset that's catching the eye of big institutions. It's a pillar of DeFi and the whole digital economy, really.
Right. It's not just about the price. It's about the technology, the innovation, the potential to change how we think about finance, and heck, maybe even the world.
We've gone through a lot today trying to make sense of all this information you threw at us. But hopefully you, the listener, have a clearer understanding of what makes Ethereum so special.
I hope so too.
Here's one last thing to ponder. Given how multifaceted Ethereum is and its growing influence, what do you think its role will be in the future? What new applications, what new financial tools might emerge from this technology? Keep exploring, keep learning. That's what this deep dive is all about. Thanks for joining us.